required to make daily business decisions regarding our companies or organizations. Ladies and gentlemen, I am Dr. Saru Sethi, Senior Resident Department of Hospital Administration, PGIMER, Chandigarh. And on behalf of AHA, I am delighted to welcome you all on this very special but extremely important subject, finance for non-finance managers, as a continuum of AHA DigiConnect webinar. Sorry, I'll just take a call. Dr. Sajal is calling.
By mistake.
So as a continuum of AHA DigiConnect webinar series, which happens every fortnight. And to help us on this skill, we have with us Dr. Sajal Sen. Dr. Sen is a practicing administrator in healthcare for 13 years since voluntary retirement from Army in the rank of Colonel. Since then, he has been a healthcare practice leader in top consulting firms such as ICRA, E&Y, IPE Global, and headed many complex national and international assignments in healthcare. This included policy formulation, quality, project development, feasibility, and market study as the main thematic area. Subsequently, he moved to leadership roles in hospital operations as Vice President in Columbia Asia, Chief Operating Officer in Apollo Hospitals, and currently working as Chief Operating Officer, Apollo Hospitals, Rourkela. Thank you, Dr. Sen, for sparing time to deliver the talk today. I also welcome the Board of Executive Members of AHA to this webinar. But before I hand it over to Dr. Sen, I request all to please keep your microphones muted. We will have this session for 40 minutes and we'll keep 10 to 15 minutes for the question and answers. If you have any questions, you can raise your hands and ask them, or you can write these questions in the chat box with your name. We'll take all your questions at the end of this session. So now I request Dr. Sen to please start the session.
Thank you very much, Dr. Saru. I hope I am audible.
Yes, sir. You're audible.
Is my screen visible?
Yes, sir. It's visible, sir.
So we begin the session. The quick introduction is, we as doctors, we do not have much of a knowledge of the financial propositions which come to us. And often we rely either on the finance managers, or in the government, we have some office superintendents or clerks or accounts department who tell us what to do and what not to do. So that is one side of the story. On the other side of the story is that when we are either advising or asking or running a business or trying to develop or evolve a new startup or a healthcare practice, we have no idea, and we generally depend on the valuations proposed by a chartered accountant. I'm not saying they do it wrong, but they will do as per the inputs given. And if we do not understand the nitty-gritties or the finer aspects of the finances, then invariably we tend to ignore this subject in a big manner. And over a period of time, I have noticed in the last many years that excellent administrators weak in finance, they generally have a problem in their careers. So the purpose of this particular webinar I have tried to carve out is that we want you to understand the basic principles of accounting. We don't have to do accounting ourselves. There is somebody more specialized who will do it. But when he brings an account to you, you should be able to decipher it to a level which is practical and pragmatic for your day-to-day working. Second is what to make out of a P&L statement, interpretation, major interpretations of a balance sheet. You don't have to go into the deeper entries, but you can always question if there is an erroneous entry or the balance sheet is looking sick for some wrong entry. The third is we also want P&L of a hospital. So I will walk you through a quick at the end, a live project demonstration that how a P&L is made, how IRR is calculated, without much of an effort, how it can be done. I'm again saying you may not have to do it yourself, but you should be able to read it and interpret it the way it is supposed to be. And then we will also talk about a live case study of one of the big corporate chains about their balance sheets, whether it is healthy or not healthy and how they are doing. So that to give you a practical example of what we have gone through in the initial slides and how it can be interpreted in your day-to-day studies. So thank you very much for all the participants who have taken interest and joined. Grateful for this. So normally there is a something called generally accepted accounting principle or gap. So any accounting has to follow a certain norm or a process. Like in our medicine, we have to have a Bible called the Hutchinson's. A general examination has got a pattern. And you would find that most of the case sheets in the country, we always write no pallor, cyanosis, adenopathy. So similar process is there so that everybody can decipher the patient's condition in the quickest possible way without having to look at various places. Similarly, the GAP has also standardized the system of accounting so that anywhere you go, you will find the same principles being followed so that you can get the same interpretations and same outputs. So it is basically a common worldwide accounting platform, an accounting convention. I would say that it is not a rule, it is not a statute, it is something, a convention which people follow across the globe with minor customization here and there. So first principle in GAP is that there has to be a distinction between the owner of the business and the business as such. If I'm making a business account and taking money, drawing money into business account, I cannot, mix it up with my personal account. Even if I mix it up with a personal account, it will be treated as a business entity and a business account. So therefore, there has to be a distinction between a business and the owner. The owner is a non-existent. He can be anybody. But the business is considered as a live entity which has got some life, which has got some activity, something is happening into it, something is going out of it, and therefore it has to be accounted for separately from the owner's own wealth. It is a separate economic unit. It is a legal entity. And any business by principle means a business goal is to make profit. So therefore, when we define business, there are many definitions. One of the definitions is that every business has to make profit. So therefore, this is a business has got its own entity. Accountants regard owners, creditors and suppliers, employers as the parties and the transacting business. So anybody else who enters into this business, whether it is owner or creditor or supplier, they will all be called as the parties who are transacting business, but their business will be a separate entity. Now we come to the
Sir, sorry, sir. So the slides are not changing.
okay, just a second. Let me see. Let me
It has
go.
changed now.
Okay.
Changed now.
Okay, I will go in the non-slideshow module that it will be showing. Okay, thank you. Has it changed now?
Yeah, it has changed now, sir.
Okay. So we'll go in the non-slideshow mode, no problems. So in the accrual principle means that obligation to pay and actual movement. The example is very clear. Suppose I buy a equipment in the month of, say, September, and I give 30% payment, and then I pay in the next financial year the balance of payment. So it is not that the expense on this equipment will be booked in the next financial year. No, it will be booked in the present financial year, and it will be on accrual basis. Basically, we will say we have already accrued the expenditure. We will have to show it, and we will have to show it as payable or provision for the next year. So many companies, many organizations try to hoodwink this by buying an equipment and showing a deferred payment and trying to make their profit and loss healthy. But that is not something which the convention and the law allows. You have to do it on the same. So therefore, this is called accrual principle. If you have bought a capital equipment in the financial year, it has become your asset. You have taken it into your books of account. Whether you have actually paid for it or not, that payment will have to be shown as your expense in that financial year and not in the next financial year. The next is going concern. It assumes that the firms and organization will have uninterrupted existence till eternity. So there is no end time or end life of any firm. The firm is supposed to be eternal. So therefore, there is no business cycle. You have moved from one financial cycle to another financial cycle, but the firm's life will continue till eternity. So therefore, there is no end life of a firm. This is the next principle. Then historical cost principle is that whatever money assigned to each asset, its original price paid for, plus its expenditure, whatever you have incurred to install it or to equip it or whatever you have given in the terms of installation, that is what is called the money value of the capital asset. There is a common word you would have used very often. You have asked the depreciation. Now, depreciation is something where we say that the value of the equipment every year will get down by a certain portion because there is wear and tear, there is obsolescence. We have already used it. If you go to the market and try to sell it, you may not get the same price. If you have bought a car, within 1 year, the depreciation of the car takes place by, say, 50,000 or 1 lakh. So what has happened is that every equipment depreciates. So depreciation basically is a method by which you are allowed to charge it as expense and save on taxes so that you are actually accumulating this expense and the saving on taxes over a period of time to replace that equipment when you require to replace it. So that is where the companies started the depreciation as a tool to create a pool for future buying of equipment, and therefore saying that my equipment's life is 10 years, every year it is dying. I can't keep it every year, so I need to have some depreciated value to be taken out of my profit, to be taken out of my expense. And because my expense is charged, whatever profit I made, by that much degree my taxations will come. I'll explain this way. Suppose you have a total expenditure of 100 rupees and you have another 100 rupees worth of equipment which needs to be depreciated. So your expenditure will become 110 rupees. So when you book your profit and loss account, you have sold goods for 150 and you have booked an expense of 110. So therefore your profit is 40 rupees. So you will get your taxation on 40 rupees. But if you had not charged the depreciation, your profit would have been on 50 rupees. So therefore, your tax would have been on 50 rupees. So therefore, there is a taxation relief which you get on account of depreciation, which straight away goes into your bottom line. And at some point of time, you can easily have a certain portion of this fund to be used for replacement of equipment. But depreciation one cannot do arbitrarily. Therefore, there are laws given. There is a drawdown method and written down method and how much percentage you give. But I think 10% is the usual depreciation for most plant and machinery. And in the Companies Act, the accountants know it is given what machine can be depreciated to what value. Fine. So we go there. So therefore, book value may not be the market value, which can be realized on liquidation. Sometimes a book value can be 2 rupees, market value can be 20 rupees. It is a vintage item or it is a painting which you bought for 20 rupees as book value. Now it is 2 crores. So you cannot take 2 crores. Book value cannot be taken as market value. You will have to have a different system for that. So therefore, having said that, these few principles, they are not complicated. So I'll quickly summarize that business is an entity. It should be separate from the owner. Second point is there is something called depreciation, which you are allowed to charge for every piece of equipment which you have. Third is that every business entity is considered as being eternal. It is never dying. And therefore, until unless the company is liquidated, sold off to another entity or totally shut down with all assets being auctioned, then only it can shut down. Otherwise, as an accounting principle, till such time the company is existing, it will continue to exist eternally. These are the 3 key takeaways till now. Now we come to a very basic thing, profit and loss. You have got a goods for 100 rupees. You buy us, you sell these goods for 110 rupees. You say, I made a 10 rupee profit. So this is a very simple way of saying what is profit and loss. But in business, it is not so simple. In business, we show it, the accountants, they tend to make it more complicated. So I will also initially show you a complicated one, and then I will simplify it. So we say net sales is 90, cost of goods sold is 65. Employment means cost of goods sold is whatever is the cost that is incurred for the sale of goods. Suppose I had a net sale of 90 rupees and I have sold goods worth 65 rupees. My employment cost is 19.5. My material employment means my staff cost is 19.5. My material cost is 46. So what you have done, you had a cost of good as 65 rupees, whereas you have already sold it for 90 rupees. But out of 90 rupees, this cost of goods sold has got two components. One is the good as such, then there is a staff cost, and then there is a material cost in either manufacturing the good or servicing the good. Let us take it in the name of the hospital. There also they use the COGS only, but in the COGS it is patient care. So you have serviced say X number of patients, and these X number of patients have paid you a bill of say 65.5 rupees. Out of that, what are the costs involved? We will show it to you later. Basically, man, power, material, raw material, consumable, and food and beverage, and so many things are there in caring of a patient, linen, laundry, all that comes, and that becomes the cost of goods sold. And therefore, if you have sold the patient care services for 90 and all costs combined, if you have incurred a cost of 65.5, your gross profit is 24.5 rupees. So this is where you have to say that when we say cost of goods sold, it has to have all the cost elements. Now let us take another example. Gross profit 24.5. Now there are operating expenses. In operating expenses, now we will say there is operational expense, there are administrative expense. Means administrative expense less, let us say marketing is an expense. Let us say you have rented some, hoardings, that is an expense. You have also given some administrative, like you have office boys, peons, clerks, accountants who are working for you. They are not directly involved in the servicing of the patient, but those are cost of overheads. So they can be called as administrative expense. Then you have to have charged the depreciation also, which I explained in the earlier slide. So from gross profit, you come to operating profit, which now comes to say approximately 13.55. Then there is something called non-operating profit. I will deal with it subsequently. We will talk about this subsequently. So what happens is when you hear the word EBIT, earnings before interest and taxes, because there is something called EBITDA and there is something called EBIT. EBITDA means there is a D between B, I and T, means the BI and T के बीच में there is a D. So when we say earnings before interest, depreciation, taxes and amortization, that is the common word you must have heard, EBITDA. Here what you see in the upper half only, I have already charged depreciation. Therefore, you have come to earning before interest and taxes. Interest is if you have borrowed some money from a bank and you have to return it with interest. So therefore, whatever interest you are incurring on that capital which you have borrowed, then that becomes a non-operating expense. So therefore, earning before interest and taxes is the best indicator to understand how healthy your profit margins are. Then suppose we say we also pay off the interest. If we pay off the interest, now we come to a conclusion. Now profit before taxes. Now it is 14.80. Suppose the taxes have been calculated in a manner that you are in a 20% charge or a 30% charge. That is something which you cannot predict. It depends on what kind of tax model you are, what all tax liabilities you have, what tax holidays you have. So nobody can predict. So therefore, the best case when you want to see a profit and loss account, you should see only up to EBIT and you stop there. Earning before interest and taxes. Once you know that earning before interest and taxes is healthy, then you know that the business entity is doing good. Thereafter, we can say profit after taxes, retained earning, dividends. You don't have to bother about it. These are some additional features. I, as an operating manager, should be interested either in EBITDA or EBIT. These are the two areas where I am interested in to see in a profit and loss account. So therefore, quickly summarizing, when we say operating expense and when there is another called cost of goods sold, There are two different things. Cost of goods sold is the direct expenses which are incurred directly related to goods. And your company is running, your hospital is running, you are operating it, whether you are running, having patients or not, still you incur certain expenses, electricity, power, water, fuel, and so many things. So they come under operating expense, and therefore you apportion them, and then you deduct it from your gross profit to come to a conclusion called operating profit. And from operating profit, you have something called earning before interest and taxes. So that is where it ends. What are the cost? When I have just discussed some cost, you should also have some concept on the cost. Their cost is basically direct material cost, direct labor cost, direct expenses. Then there are something called production overheads, which can be indirect material, indirect labor, indirect expense. Then there are something called administrative overheads, selling overheads, and distribution overheads. So all these words, let us see in the subsequent slide, we'll get some more idea about it. Material which becomes part of the product or part of an aircraft or part of a deal. I am deliberately taking the industrial route because I can then compare it with the healthcare and then simulate it. So therefore, if you are operating a patient, there are consumables. You have done an angioplasty, the stent becomes the direct cost. The catheter becomes the direct cost. The suture becomes the direct cost. The medications become the direct cost. So therefore, and whatever has been actually incurred and disposed of, either it goes with the patient or is one-time use and gone, that becomes direct cost. Similarly, the doctors, the technicians, the nurses who have treated the patient in the cath lab and subsequently in the cardiac ICU, their charges would become the direct labor cost. Then we have expenses which incurred, which are much part of the product, such as direct material, drawing or design of products or prints. This does not incur much in healthcare. We are mostly interested in direct material and direct labor. In some cases, direct expenses also come. That comes in the operation theater, where you have got a scrub station, you have got a common philosophy, you have to have sterilization expenses, which you have to apportion, you have to manage certain HVAC in the system. Those becomes expenses which are to be apportioned for each theater. There we can say it is a direct expense. Now, overheads are production overheads, like stationery, like printing, like all those you are using markers, you are using stickers, you are using drapes. So those all becomes indirect material. Indirect labor is like you have got you have got supervisors. There is a nurse who is directly nursing the patient, and there is a charge nurse who is actually charging and supervising and seeing that everything is being done right. So in every ward, in every department, there would be one supervisor, one charge nurse, and two direct nurses looking after patient. So those become indirect labor. Indirect expenses like insurance, depreciation. In each patient, it may not be charged, but it will become part of the overheads which you have to factor when you are costing a patient for a service. So there would be depreciation, there would be insurance of the equipment, there will be insurance of the building, there is medical insurance of your staff, there is indemnity insurance of doctors which you might have paid. All that factors also becomes your overhead. So therefore, while charging a patient or pricing a patient service, you have to take all that into account and see how you can actually apportion it across your customers in a small bits and pieces so that you can make good the losses. Then we come to administrative overheads, office building and furniture. Sales overheads is something which is not common, but these days hospitals do a lots and lots of marketing. They go to media, they go to TV, they go to social media. Then there are hoarding, though Medical Council has recently put a lot of restrictions, but the surrogacy continues. If you go to Faridabad, Noida, every square you will find huge hoardings of large hospitals which are there with the services or hip replacement or knee replacement or angioplasty being advertised, and they cost crores. So therefore, they also becomes your sales overhead. Distribution overheads or warehouse. Sometimes these many hospitals, they create partners, they call associated providers or private practitioner network or network doctors. This is nothing but basically to give them referrals for continuum of care on harnessing patients. So that also becomes a distribution overheads in long run. And many of them, they are paying by check by deducting TDS, though I don't subscribe to this idea, but this is one example where such things are also happening. This is a hypothetical, or I would say a more philosophical cost, which I would just want you to remember and forget. I mean, just go through and forget. Or if you remember, it is fine. It's just a value addition to the current webinar. There is something called opportunity cost, which you remember that there are certain times when you actually have an opportunity which you have not been able to encash. It is something like you have a full-fledged cath lab and you have only one doctor and you are getting many patients every day and his queue is very long, and many patients finally they decide that we cannot wait for such a long time for a procedure or for a consultation. So they decide to go to other places. So therefore, you are in a dilemma. Should I take one more doctor on salary? And if I take one more doctor on salary, will he be able to service these patients? So you actually say that I am losing on opportunity. There is an opportunity cost involved. If I don't take a doctor, I am incurring a cost of opportunity by losing so many actually customers who could have been serviced in my hospital. So therefore, this is a very, very naive and basic example of opportunity cost. Larger corporates and companies, they invest billions of dollars in terms of mapping their opportunity cost and trying to see if they can invest and make money. Many a time this becomes a gamble also, but this is one cost which is taken into account for a business or an investment decision. This is something very important, activity-based costing, which you should know. I think my colleague, who is the president AHA now, he did a very good activity-based costing study of the nursing services in a large super specialty hospital. I still remember his study, and it is so relevant till date. I would request Dr. Yashpal Sharma to reshare that to any August group, that study which he created. It was a historical study. So it was again based on activity-based costing. So this is something where you actually describe when we say ki how much is the cost of treating a patient in OPD, you will never be able to know until unless you go to the elemental activities and see what all activities are happening and for how long. Example, a patient walks into the hospital, goes to the reception counter, reception will do the registration and they will guide them. Then there would be an usherer who will take them to the concerned specialist, and there would be somebody taking vitals, and then the patient is seen by the doctor. Then he goes to another registration counter for investigation, and then he gets himself investigated. So all this manpower, you have factored 2 minute every activity you write, and you write how many minutes this person has spent on those activities. And therefore, this bunch of activities will become total number of administrative work which has been done on the patient on various activities, say 45 minutes. And you have got per person, administrative person cost is say 12,000 rupees for every secretary or every ANM who is doing this thing. So you divide that, all right, my daily expenditure is so much on administrative people. Out of that, 45 minutes worth of time in terms of cost is going towards servicing one patient. Therefore, it becomes one way of activity costing. Another way is like when we have to rationalize nurses, we have to see how much is the nurse involved in nursing activities and non-nursing activities. So if you have, it is the ratio is actually, ideal ratio is 70-30. As long as the nurse is actually doing nursing activities, whether it is care of bowel or back, care of oral or back, it is whether it is vitals, whether it is administration of medicine, drawing blood for investigation, doing documentation, maintaining monitoring charts, turning over the patients, making sure that he takes feed, all that, rise tube aspiration, rise tube insertion, all that given. So in ICU setting, 5 hours, 4 hours per patient per nurse takes. But instead, if the nurses are more involved in inventory management, calling the pharmacy for drug, calling the engineering department for leaking tap, most of the time involved in telephone calling and firefighting, and not doing so, then that activity-based costing becomes less, and you will tend to have more and more nurses doing non-nursing activities. So therefore, This is the sum and substance, the cost drivers you have to identify, that what are the cost drivers in the activities which you take in terms of treating a patient. Because when we as doctors or as hospital administrator, we feel, oh, ये doctor का cost दे दिया, दवाई का पैसा दे दिया, and that is good enough, the cost is incurred. No, there is a huge iceberg which is below the water, which you have to identify and create an activity-based costing, and then only you can come to a service pricing. Otherwise, you will lose money. So it ensures accurate costing of product or services basically, and costing contributes to a better pricing decision. This is what I just told you. So these are some of the jargons which are used. Costs are assigned more directly on the basis of actual consumption of resource rather than arbitrary basis. If you actually do the activities, cost them accordingly, put it in a basket and add them all together for one patient. How much is the administrative effort? How much is the medical effort? How much is the nursing effort? What are the apportionment of power, water and fuel which you have consumed? You will automatically get to know that at how many patients you will be able to make good your losses. So this is one way of doing your activity-based costing. So now we come to the third part called cost volume profit analysis. This is a very interesting kind of a concept. Suppose I have a profit of 6 lakhs and I have sold zero point 0.6 lakhs and I have sold 5 lakhs rupees worth of goods, and my fixed cost is 1.4 lakhs. What is my break even point? So this is a small exercise. I am trying to basically represent it so that you understand three concepts in one go. What is a break even point? Break even point is when my cost of business and the income both are equal. Neither I am making any profit nor I am making any losses. So when I come to that level, that is called the break even point. So in this particular thing, there are few formula which I can, I will share this PPT with everybody who wants. So profit is equal to 0.6, sales is equal to 5 lakhs, fixed cost is 1.4. So fixed cost plus profit is equal to contribution. So your contribution is 2 lakh rupees, basically. So once you have known the and fixed cost upon contribution into sales is 3.5 lakhs, that is the fixed cost is 1.8 lakhs, then fixed cost plus profit is equal to 1.8 plus 0.6 is equal to 2.4 lakhs. Break even point is FC upon contribution. So therefore it is simple arithmetic, and you will come to know that your 3.75 lakhs, you have already done a break even. So even if sometimes you get profit, it is not necessary that you have reached a break even point. Why? Because you have already got cumulative losses from the history, from backward. So until and unless you reach that level where you are able to say that my expenses, not operating, my complete expenses of the project or system and my complete revenue which I got, both are neutralizing each other, that is called break-even point. So this is one of the methods and the basic formula for break-even point is, just remember, fixed cost upon contribution into sale, and contribution is equal to fixed cost plus profit. That's all. These two, once you remember, there is no way you can forget, and you can easily get a break-even point for any work you do. Next concept which I want you to know, or I would like all my colleagues to know, is called NPV. Particularly when you are sitting in a situation where you want a linear accelerator to be placed in your hospital, whether government or private, and whether you want to know that under what, whether if I invest this money or I get somebody else to invest and rent it out to me, which one is better? So there is a question, something concept in entire financial world is called net present value. It is basically present value of a net cash flow from the project minus project net investment. And then this is not very complicated, I'll tell you. Something like you take a period of 10 years and you say every year I have invested 100 rupees. Every year I will start getting first year 5 rupees, second year 7 rupees, third year 8 rupees, and so on. Till 10th year, I will be able to earn, say, 150 rupees. Okay. But I invested 100 rupees. So in the common sense, we say, oh, I interested 100 and I got, after 10 years, I got 150, I made profit. No. You have to see the value of that 100 rupees today and what would be the value of that 150 rupees today. You have to compare it in that way, because the inflation factor will be there and your depreciation will be there. So even if you have earned a 50 rupees premium, it is not necessary that you are going to run a profitable business. Therefore, what they do is, if a decision affects cost and revenues at future dates, it is necessary to discount these costs and revenues to present values. So there is a discount formula in NPV. It is very closely there it is very easily now in Excel. You don't have to do many things. Go to the Excel in the statistics part of it, and then you say that, all right, I want to do NPV. So you just chart out the yearly fund flow which you have projected, that I investment 100, 110, 120, 30, 40, 50, and then you just select that and you say calculate NPV. It will give you a net present value of the money. So what is the interpretation? It accounts for the time value of fund money and can be used to compare the rates of return of different projects, or compare a projected rate of return with hurdle rate required to approve an investment. Suppose your net present value, it comes to approximately 50 rupees, and if you have put that money in government bond and you get an NPV of 70 rupees, which is better? Why should I put my money? I rather put my money in government bond and get more money and ask somebody else to do the investment, who can probably run it more efficiently instead of me running it inefficiently. So there are times when the NPV becomes a very good decision making tool. Discount rate is the central to the formula. So this discount rate, many a times you will get it in the net only. What is the current discount rate? Discount is what percentage you will put as the discount towards the end. Suppose I convert 100 rupees into 150 after 10 years. How will I discount that 150 rupees value? 4%, 3%, 2%, 7%? How will I say कि 150 रुपए में से कितना परसेंट कम करूं, so that it gives me the present value? That is the calculation. So that discount word is generally done by lots of, there is a consensus every year that how much is the discount to be given. RBI also gives guidelines or NPV, and you have to simply put that discount, select the whole data sheet, is complete data of annual income after investment, get the NPV, and then you would know whether the net present value of the money is less or more than investing in a FD or a foreign bond or a stock exchange, whichever is your, or even two projects differently. You can have a linear accelerator or you can have a Halcyon. In case of Halcyon, probably your NPV is better than a government bond. In case of a true beam linear accelerator, keeping in view poor inflow of patients, which you don't have as many in that area, you can have a poor NPV. So you can take a decision and decide. The last word which I would like to use in the profit and loss section is internal rate of return, IRR. You would have all heard this very commonly. IRR nahi hai, to kya karna? What is the IRR? Again, IRR is also another tool. Net present value is not that accurate because it is basically based on an arbitrary discounting method which has been decided by the globe and not by you. So therefore, they found out another sharper tool called internal rate of return. Here again, it is an Excel tool. You simply select the every year's income and just say calculate IRR with a discount rate, and it will give you. This discounting rate for IRR is also, it is based on certain interest rates which is given by the RBI from time to time. And it should be, and the criteria for acceptability is IRR should be higher than the cost of capital. Means, if you have borrowed 10 rupees and your interest is 5%, the IRR should be 7%, 8%, or 10%. Then only you are in profit. You take borrowing from the suppose it is not your own money, and so even if it is, I'm sorry, I'll repeat. You take loan from the bank 100 rupees and you are paying an interest of say 11%. So every year you are paying 11 rupees on that 100 rupees. Now, suppose your internal rate of return is 7 rupees or 8 rupees, then in that case, it is a bad investment. But if your internal rate of return is 12 rupees or 13 rupees, then it is a good investment. So that is how we say that interest on borrowed capital should be less than the internal rate of return in a good service case. Now, suppose I say, I'm not borrowing, I am using my own money. In that case, I compare that had this money I have kept in the bank and earned some interest, whether the IRR of the investment is more or the interest is more. So that is how you calculate IRR. And the end of the presentation, I will walk you through a couple of Excel sheets very quickly to understand. Now, suppose the third tool is balance sheet. Balance sheet is something I know all of us are very dreadful at. It has got so many current assets, current liabilities, God knows what all it says. How do they match both sides? We don't understand. Just forget it. The accounting system is profit and loss is I have sold goods, I made some profit. I have factored all the cost incurred and I came to a operating profit. I paid my interest. I go to the interest earning before the interest and I get to a EBIT level and then I stop there. So that is very simple. But in case you want to see the business is so complex, I have purchased things, I have not paid for it. I have sold things, I have not realized money for that. But all that is coming in the profit and loss account. In profit and loss account, it is not on basis of that is something else is called cash flow account. I am not dealing there. I am saying profit and loss account is an account of numbers only. Physically, that note is not may be there, may not be there. So therefore, when we book P&L, we book P&L based on the accruals. Like I have sold goods of 1,000 rupees worth, but I am yet to get 500 rupees back from the customers. But I have sold goods 1,000 rupees, so I will put goods sold 1,000 rupees. Similarly, I have bought raw material for 200 rupees. I have not paid my supplier, but I will book that as an expense to her 200 rupees. As and when I pay, that will be my cash flow statement. But P&L, so there are liabilities for me to pay to somebody, and there are assets which are available with me which can be liquidated. So therefore, assets, whatever I have, and liabilities, whatever I have, they have to, for a healthy firm, they need to be equal. Therefore, a balance, that is why they should be balanced. Therefore, asset is equal to liability. Balance sheet means assets is equal to liabilities. In the liability, one more thing is the stockholders' equity or the share capital. If I had pushed 100 rupees to start my business and I have liabilities to pay to many people, I have to liabilities to pay bank, I have liabilities towards interest, I have liabilities towards the what you call as the firms, people who have suppliers, all that, and my own money is liability because I have actually infused that money. As I told you in the beginning, that my money has now I have become an investor. It is not my money, so I cannot take no. I'm an investor and business is a separate entity. Therefore, shareholder or capitals infused is also a liability because someday I need that money back to do something else. So therefore, that also becomes liability. And what are the assets? We will quickly go through. I don't know whether this is visible or not, but I have just given a quick snapshot of assets can be current assets and fixed assets. Current assets are those assets which have got a liability period within the financial year, one financial year. Cash, whatever is available, is current asset. Account receivable is also your asset. Inventories which you hold is also your current asset, and all others, anything else which you can calculate as assets, that becomes total current asset. Then there are long-term assets also called fixed asset, property, plant and equipment. Earlier they used to be called as non-tangible, tangible and non-tangible assets, but now they have defined after Ind AS 2 that they will be called property, plant and equipment. Then depreciation can be removed from that. Net property, plant and equipment, intangible assets and others, and total fixed assets. So there are fixed assets. Similarly, on the right side, you have payable, whatever you are due to people and supplier, that becomes your liability. Notes payable become liability. Accrued expenses, which will happen subsequently. You have consumed electricity, but you will pay subsequently. So that becomes your liability. And therefore, these are current liabilities. There are something called long-term liabilities. Taxes. You will have to pay taxes at the end of the year, maybe 6 months after that. Your financial year finishes on 31st March, but you file your return in the month of September. So those are deferred taxes. So they will become your long-term liability. Similarly, stockholders' equity or shareholders' equity, he can ask for a liquidation at after the lock-in period. But that money is not yours. You will have to finally give it to back to him someday with profit. So therefore, that becomes your liability. And then there are some common stock and capital surplus that is you forget about it. These are some complicated issues. But you can simply say that there are two kinds: current asset and fixed asset, current liabilities and deferred and long-term liabilities. Both being combined, they become the balance sheet of asset versus liability. Two words you have to remember: current assets and current liabilities. We will start from that because that is where you have some control. On your fixed asset, you have already created a hospital. You don't have a control. But what you have a control is on your current assets and current liability. So these are some of the things which are there. Equity shareholder fund is a liability. Non-current liabilities are borrowing, deferred taxes, liabilities. Current liabilities are short-term borrowing, trade payables, other current. I have already explained this. I thought I will further, amplify just to just to give you more idea what is current asset, what is non-current asset, what is liability, and what is long-term liability. So nonetheless, I'm sure you would have understood, and you don't have to get into more details that what comes under fixed. That is your accountant's job. You should know how many current assets and what is the long-term assets, what is the current liability, what is the long-term liability. These two things you have to remember. The internal entries will be done by your chartered accountant. I don't think you have to get involved. This is just an additional knowledge. From this, you can do something called current ratio. Current ratio is something when you see a balance sheet, just two things. One is called current ratio, and secondly is called acid test ratio. If you can see that, you will be able to understand the health of the company. Current ratio is nothing but current asset upon current liability. Why? Suppose I have 1 rupees of asset, I have 100 rupee of current assets, and I have 100 rupees of current liabilities. So my asset upon liability is 1 upon 1. So it is unity. So there is no deficiency. But suppose my current asset is 1 and my liabilities are 1.5, obviously the ratio will become less than 1. Then this is alarming. That means that my asset versus liability is not matching. Now, what happens here? The trick is there are sometimes current assets have inventories also, as I told you. Current assets have got large payables like your receivables. I have done business. I have not been able to recover. I have 200 crores of outstanding lying in various companies. I have 200 crores worth of inventories lying. All that is my current asset. But those are dead assets. If and on the liability side, suppose I have 200 and both 200 and 200 are matching, it gives a false picture. It gives a false picture because many a times in that particular year, you may show a very healthy balance sheet that current ratio is more than 1 or 1, but actual sense, you have not recovered that money from the market. You have not you have got you have got inventory which is jammed and which is going to expire, but as book value, your current asset is healthy. So this is the disadvantage in a current asset scenario. So that is why they said, let us take a acid test ratio or a quick ratio. Acid test ratio is a measure how well the company can satisfy its immediate financial obligation. This will break down how to calculate the ratio step by step. So you forget about this. This is also available in the Excel only. You just go for a quick ratio or acid test ratio. But this is more sensitive ratio in a balance sheet to understand whether the company is healthy enough to meet its expenses or it is going in red. As bolte na, they are going in red. So when we say they are going in red, means their asset versus liability ratio is less than 1, and therefore their balance sheets are unhealthy. Some balance sheets become minus 400, 500 also, like Kingfisher Airlines and all. They have all those assets, but they are jammed assets. They are of no use. So if he had been showing those as assets and creating healthy balance sheets. One day they realize that half their asset is grounded, which is not even working condition. What will he do with that inventory? By showing it the valuation, it is a false. So therefore, you have to know two things: current asset, current ratio, and acid test ratio. Looking at a balance sheet, look for these two. Then there is something called inventory triangular. There is another small example I have given. This is current ratio. This is acid test ratio is basically current asset minus inventory upon current liabilities. You see, as I told you, dead inventory can be a can create problem, and therefore dead inventory can fudge your result in current ratio. Therefore, in the acid test ratio, they have done the formula current asset minus inventory upon current liabilities instead of current asset upon current liability. Then you see and then you calculate where it is coming to, and then you can actually understand what kind of indices you are getting. Here is an example of balance sheet of Fortis Healthcare, which is published in the public domain. Now I would like you to go to the straight away go to the current liabilities. Your current liabilities here, total current liabilities is 648, 1094, 1228, and you can see, just in some of you can note down somewhere that it is between 600 and 1000 and 1200 in that ratio. Current liabilities. Okay. We are talking about total current, no, this one. Total current liabilities, 756, 462, 472. So this is, if you can see my arrow, this is the current liabilities. Now I go to the next slide and I show the current asset. Current asset here in the year, first year is 690, and in the same year, your current liability is 756. So what does it mean? Asset divided by liability means approximately, I'll take mota 600 divided by 700, that comes to 0.85. 0.85 means it is an unhealthy current ratio. So if you take each year, their current ratio has been unhealthy for the last 4 years. So basically, Fortis is actually surviving on the infusion of funds from the foreign investors, so that they can continue to remain afloat. And very soon they will turn around, they will again make profits, their assets they will remodify, they will sell off some of the dead inventory and come back to shape. But this is one way to show that how a large corporate, this is a published report, I have not made it, this is something which is available in the net, and you can see that their current ratio is less than 1 for the next 4 years. And yet they are running very efficient hospitals because they are continuously infusing the fund from outside to bridge the deficit. So this was one example to show how a balance sheet can give you a quick idea of how to interpret the health of an organization. Now, I will quickly take you to a small Excel sheet. This is one Excel sheet where basically this is a business model for a medical college hospital. So we have done some assumptions. These assumptions are based on number of students, how many will come, what will be income from tuition fee, what will be income from hospital, what will be OPD charges. And at the end, we come to a financial. In the financial, you see, we have measured each and every. This is the capital cost. So capital cost, capex for equipment, furniture, building, hospital capex, net block. This is done. Then we go to revenue, escalation, surgeries, procedure, how much you will earn operating revenue from each of these activities on a CGHS rate that has been given. Revenue from medical college has also been factored. And then what we do is operating revenue. That comes finally, revenue from hospital, revenue from medical college, total operating revenue, say 139 crores. Now we go to the expenditure. Expenditure, we have land cost, manpower, operation, maintenance, power, water, fuel, wastage, waste management, all these, so many costs you have to take. And finally, you come to operating expenditure summary in million, whatever is the total we have given. Total operating expense, say whatever is 139. So then we talk about what will be the cash flow. Cash flow from operating activities and cash flow from investing means you will get money from outside. That is how Fortis will do. They will manage their cash flow by getting investing from outside. Then the government, since it is a PPP, there will be some money which will come from the viability gap funding. That is also factors. After doing all that, we come to net cash flow, and then we go to what is the net present value of the investment and what is the projected IRR. In this case, the projected IRR is coming to 24%, where by taking IRR, you can see C93 and AF93. C93 and AF93. See this. This is the this is the
Sir,
this is
is it
the one which
Sir,
has been
the Excel is not seen, sir.
not seen, sir? The model is not visible.
okay. Is that so?
You have not opened the model. Yes.
Oh, I'm so sorry. Let me do that then. Let me find out if I can. I have to stop sharing the PPT then. Stop screen sharing. Then I again share. Okay. Is it visible now?
Yes, sir.
Yeah. So here again, I will quickly go through in 1 or 2 minutes. This is a medical college project live report where we have everything factored here. As I said, initially we have some assumption sheets where we assume what is the percentage, what is the NRI seat, how many admissions, how many discharges, how many students will come, etc., etc. Then we come to some period, that how much was period. Those are assumptions which we can take, and then we straight away go to a financial where we say now I come to the profit and loss statement where we have said that this is the capital expenditure, building, plant, machinery, equipment. Then we talk about what are the revenue sources. We say procedures, investigation, consultation, bed charges. Then we have admission, tuition, hostel for students. There are two streams of revenue. One is the tuition fee and a student teaching program, and second is the patient care. This is a medical college model. I have deliberately chosen to make it a little complex to more understand. Then we map all the expenses, operation, maintenance, administration, everything. And then we finally come to the conclusion that what is my income and what is my expense. And finally, we come to a situation where we say, what is my net cash flow? Cash flow from operating activities, cash flow from investing means whatever VGF we get or whatever investor we get, and whatever financing activity means whatever bank loan we get. And we have already factored everything as interest, and everything has been factored in the expense. After that, we say net cash flow. So if you see, I am calculating NPV. NPV is calculated again on the same this row, this one, and IRR is also calculated 24%. If you see, it is coming C93, AF93. This is row number 93. What in the Excel we have to do? Just select all these numbers, right click and say calculate IRR, and you just put the discount rate of 4% or 5%, whatever has been prescribed by this thing, RBI. You straight away get the result. And 24% IRR is a great number, because at the most you will get a borrowed capital of 12, 13% or 14%. Whereas you are getting 24% IRR, more than the interest you will give on your borrowed capital or the capital you have infused. Therefore, this is a viable project. Rest, you can always have all these, tentative list and all. That is a different issue. My main motto was to show you how RRR and NPV are actually being done in business modeling and in day-to-day accounting, so that you understand the viability of the project. I think I have finished my presentation. We stop here and we can have questions if there are any.
Thank you so much, sir. It was really an informational talk. I would say it may be a 1 hour session, but it is in the right direction for us to scratch our heads to know more about the finances. So now I would ask the audience, if somebody has any question, they can raise their hands, or they can ask the questions. They can type that in chat box also. Okay, I think there's no one, sir. I just want to ask one thing. Yes, Dr. Dheeraj Arya. Dheeraj Arya has raised her. Please ask your question.
Good afternoon. Good afternoon. Can you hear me?
Yeah, we
Yeah.
can hear you.
Uh, so, so thank you for the presentation. So I know there is not much of the time, but can you just highlight something on the EBITDA part?
Yeah, EBITDA part is basically, when you have you have sold something,
Yes.
you have bought something at 100 rupees and you have sold something at 120 rupees, you say you have made 20 rupees at profit. But then you have to see that while doing that 20 rupees profit, there may be many other costs which are involved: power, water, marketing, sales, everything. Those are called operating expense. So you remove those expenses from the 20 rupees to come to a conclusion called operating profit. So far, so good? So far, so good?
Yeah.
Okay. Now, once you have done the operating profit, now you have got one term called earning before. EBITDA is earning before interest, depreciation, taxes, and amortization.
Yes.
So, earnings before interest is if you have got a bank interest, if you have got depreciation. So, I have already explained depreciation. So, from this is called EBITDA or operating profit. After operating profit, if you charge depreciation and remove depreciation by 10% of all cost of your equipment, it will come to something called EBIT, earning before interest, taxes, and amortization. Once you put the taxes also, then you come to the net profit, interest and taxes, then you come to the net profit. So this is how it is happening. So everywhere we actually look at EBITDA or EBIT, mostly EBITDA only, because that is how we know how the business is flaring. All costs have been already taken into account. Only depreciation, interest, and taxes are left, which are not in my control. Depreciation is already to be booked. Taxation is as per government laws, and interest I have already committed. I hope I have answered the question.
Yes. Thank you so much. Thank you so much.
Yeah.
Thank you, sir. There's one query in the chat box. Dr. Arun Gupta wanted to ask, are there any suggested resources to go through?
Yes. There is a book called Finance for Non-Finance Managers. I read it a few years back, and I will search for it, and I will give you the name and the author and everything. My colleague Shubhi will circulate to all of you. I will give that today only. Yes.
Thank you so much, sir. And there's one more. Do companies actually keep the cash aside for depreciation?
No, this cash aside is not kept for depreciation. It is basically they keep it as their reserve and surplus.
Thank you. Dr. Vishika Singh wanted to ask something.
Yeah.
Dr. Vishika? Are you there, Dr. Vishika?
I think Dr. Arun Gupta has raised hand.
Yes, Dr. Arun Gupta.
Thank you, sir, for a nice presentation. What I meant from keeping the cash aside was, do they actually keep that money so that the example that you took, that for 10 years they will keep 10% depreciation, and do they keep that 10% cash as reserve so that at the end of that cycle at 10 years they have the ready-made money to replace that asset?
Yeah, that is the purpose of booking depreciation. One of the purposes of booking depreciation, that it is kept as a reserve and surplus. And reserve and surplus is something which has got two functions. One is to reinfuse in capital, and second is to give dividend to the shareholders. So reserve and surplus pool will be there, and from that they can buy. That is the purpose. You are correct. But we don't keep it. Every equipment depreciated by 10%, we don't account for it and keep it in its name. It is a common pool, but that is how it is used. Maybe after 10 years, you require some other technology, you never know. But therefore, they keep it for capital expense as a whole, not as equipment-wise probably.
I believe in case of financial institutions,
Hmm.
RBI has given a directive to keep that money aside, and RBI has a look at that, whether they are keeping that kind of money aside or not. Is it true?
No. It is a reserve and surplus. It is part and parcel of reserve and surplus. Depreciated accounts cannot be kept separate. That
Okay.
they cannot enforce. No.
Thank you.
Thank you. Thank you so much, sir. Dr. Vishika, you want to ask something?
Yes, ma'am.
Yes,
Good
please go.
morning, ma'am. Good morning, sir. So, as we know that big firms usually do not keep cash as an asset at all. In fact, they keep their own company as a stock in the market, and investors then invest or they buy the stock, and yet it is not taxable. Majority of it, it's never taxable, but at the same time, it is used as a trade. So, but then how we will justify that? Because I'll give you a very fine example. This Tesla, Elon Musk, what he did to buy Twitter, he simply put Tesla to that whoever will just buy Tesla stock from him, and then he bought Twitter, and then he revert back and got his Tesla back again. But so at the same time, it is not liquefying, but it is used as an asset, and at the same time he's trading at such a big amount. So I really need a comment on that.
Actually, this is something in the industrial world, despite all the regulatory efforts, there are ways and means where the big companies, they do circumvent the existing regulation, which he has very successfully done. Like in earlier days, what used to happen was, I'll give you another example, that I have a company, say XYZ Corporation, and I create 3 more seeds under me, ABC and DEF. So ABC and DEF are in a different business. XYZ is in airlines, ABC and DNF, one is in textile, one is in cement. So what I do is, I have my ABC in a very big name and very good profit, but I keep infusing money and give gap funding to the subsidiaries and keep booking losses at all the 3 and not to pay taxes. So the Companies Act came out and they said that you cannot take tax advantage of feeding your own subsidiaries. And therefore, whatever money you infuse, it will be in the form of capital and cannot be charged an expense, and you cannot be absolved from paying taxes on the main company which is already making profit. So these rules and regulations, they keep evolving over a period of time. What Mr. Musk has done is a fantastic way of taking shareholders' money and stock capital's money and using that money only to buy his own company. I think time will only tell. As of now, there is no regulation to curb it.
Yes, sir. Thank you so much, sir.
Thank you so much, sir. Any more question? So we'll finish the session here, sir. Some of the participants have asked to share the PPT, if that can be done by HA office, maybe.
Yes, go ahead. Give it to them.
Thank you.
PPT,
Thank
and
you.
if they want the Excel also, I'll give that.
Okay. Thank you so much, sir.
I'll
Thank
send the
you.
Excel also. Yeah.
Thank you for the wonderful sessions. I think now we all know the basic principles of accounting, the profit and loss of the hospital's operating and non-operating cost. So, if any issues, we'll contact with you if at all anything arises. Thank you so much, sir, for this.
Oh, sure. Thank you so much. Thanks for everybody participating. I hope you enjoyed the session.
Yeah. Thanks
Thank you.
everyone for attending. Thank you, sir.
Bye. Thank you.